Alright guys, welcome back. Today we're going to be talking about ratio analysis. Now you may be wondering why do we need to do or why do you need to learn ratio analysis? Ratio analysis is actually very important in the world of accounting. If you are intending to invest in a business, right, or if you are intending to buy a business, then you want to see the performance of the business. Ratio analysis or accounting ratios gives you that opportunity to examine, to evaluate, and to assess the performance of businesses, right? And so it's very important that you learn ratio analysis. It's a topic that comes frequently on the exam, not too frequently, but it comes. And the fact that it is on the syllabus, it means that it is testable, right? So it is important that you spend the time or take the time to learn accounting ratios and to understand what these ratios mean and be able to maybe write a sentence or two on it. All right, so let's get right into it. So we have two types of accounting ratios for this syllabus that you will be asked to learn and to know, right? You will be asked to know about profitability ratio and liquidity ratio. These are the two main types of ratios that is in this syllabus. So the profitability ratios, right? These are ratios that shows the profitability of the business, of the firm, right? Liquidity ratios are ratios that really shows how a business, right, or a debtor is able to cover their debts, right? You do not want to be investing in a business who is not able to pay off their debts, right? And so liquidity ratios will tell you that. Profitability ratios obviously would be the more attractive type of ratios, right, to investors or to persons who are intending to buy a business and so forth and so on. Because let's face it, it talks about the profitability of the business. That's the whole point of having a business, to make a profit, and so these ratios are going to be very important, right? So let's do this. All right, so let's look at a profitability ratio, right? The first profitability ratio that we'll be looking at today is the return on capital employed, or it is called the ROCE, right? Now, this is by far the most important accounting ratio that you can learn, right? That there is, right? And the reason why it is the most important accounting ratio, well, one, it's a profitability ratio. Not only that, but it shows how much profit is made on the capital that you invest. If you are an investor, this ratio is extremely important to you. All right, now let's look at the formula to calculate this ratio. Now the formulas, they are not so hard to remember, right? They are actually pretty simple to remember if you take a look at the name. When we talk about returns, right, you know, in accounting or in business, we are talking about money made or profits. So return, talking about profit, so net profit there, on capital employed. So capital employed would be the next part of the formula, right? So the formula is net profit divided by capital employed multiplied by 100. Therefore, the answer to this ratio is going to be in a percentage. Now, capital employed is a little tricky topic, right? We can't really decide on, you know, which one of the capital employed you're going to be allowed to use or asked to use. So capital employed is calculated as opening capital plus the closing capital divided by 2. In an exam situation, if you are not given the opening or closing, if you're not given the opening capital, or if you're just given one capital figure, then you just use that one capital figure. You don't have to divide anything by 2, right? In most cases, they don't give you you know, they don't ask you to calculate capital employed, but just in case you are given 2, the opening capital and the closing capital, then you know that you need to calculate the capital employed. But in most cases, it is just net profit divided by capital multiplied by 100, and you would get the ROCE ratio, or the returns on capital employed ratio. Very important, and the explanation is also important. Now let's look at another profitability ratio. Okay, so another profitability ratio is the gross profit percentage, and sometimes they will refer to this ratio as gross profit to sales, or the gross profit margin, right? So please bear that in mind. Now the gross profit percentage, or the gross profit margin, or the gross profit to sales, right? It shows how much gross profit, right? How much gross profit is made on every $100 of sales, right? As again, you're an investor, you want to buy the business, you're looking at the ratios, right? if you look at the gross profit percentage, what it actually tells you is that, all right, from this amount of sales, this amount is made as gross profit. All right, so it's a very important ratio as well. The formula is gross profit divided by sales multiplied by 100. So again, once it says multiply by 100, you know that the answer is going to be in percentage. So this is another important ratio. We are going to be looking at the net profit percentage after this one. Let's go at it. All right, so now let's look at another profitability ratio, which is the net profit percentage, also known as the net profit to sales or the net profit margin, right? And it shows how much net profit is made for every $100 of sales. Now let me see if you guys are following. What would the formula for this ratio be? Let me give you 30 seconds. Think about it. Net profit percentage or net profit to sales. What would the formula for this one be? If this is what you had, then you would be correct. So the formula is net profit divided by sales multiplied by 100. Very good, right? And so the answer to this would be in percentage, just the same. I can show you the fourth profitability ratio. It is called expense to sales, right? Expense to sales, and it goes without saying that the expense to sales ratio, right, it shows how much expenses is made for every $100 of sales, and the formula for expense to sales, right, would be expenses divided by sales multiplied by 100. This is very easy to calculate, guys, and I can tell you about a trick. If you know the gross profit percentage, right, and you know the net profit percentage, you can be able to calculate the expense to sales ratio. Similarly, if you know the expense to sales ratio and you know the net profit percentage ratio, you can calculate the gross profit ratio, right? The three are connected: gross profit, net profit, and expense percentage ratios. They are all connected, and if you know any two out of the three, you can calculate the other one. All right, so that's it really for profitability ratios. Let me know what you think. You can check out my next video where I'll be doing some practice questions on profitability ratios. All right.